Welcome to the Explainer. Today we're tackling the plot twists of accounting for contingencies. We're in Section 5 looking at business combinations, subsequent events, and the journal entries that tie it all together. If you already know the standard ASC 450 rules inside and out, get ready because we're about to look at those special situations where the standard rules get completely flipped on their head or face the intense pressure of a ticking clock.
To get us there, we'll start by unpacking the exceptions in business combinations. After that, we'll navigate the tricky timeline of subsequent events, and finally, we'll wrap up with the ultimate journal entry playbook. Let's jump right in.
Starting with Section 1, Exceptions in Business Combinations, and specifically the ASC 805 override.
Now, when your company acquires another one, it's really tempting to think you can just carry over their contingent liabilities using the standard ASC 450 logic. But actually, you'd be wrong. We hit a very strict divergence here. Take a look at this. For contractual contingencies, meaning things that arise directly from a contract, you have to recognize them at fair value right at the acquisition date. You literally throw the usual probability thresholds out the window. But for non-contractual contingencies, like a pending lawsuit, you only recognize those if they're more than 50% probable.
So what this really means is that fair value measurement completely replaces that standard probability and estimability test for contractual contingencies when an acquisition happens. Why does this matter to you? Well, it means an acquisition practically forces you to slap certain contingencies onto the balance sheet that wouldn't even qualify for recognition yet under standard standalone rules. And for subsequent measurement, you'll generally carry these at the higher of that initial fair value or the standard ASC 450 amount. It's a massive paradigm shift. Misunderstanding this is basically a fast track to audit failing errors, so keep your eyes peeled during M&A.
Moving on to Section 2, Navigating Subsequent Events and the Ticking Clock of the Balance Sheet Date. You know that every contingency has to be reassessed at every single reporting date. That December 31st balance sheet date, or whatever your fiscal year-end happens to be, acts as a really rigid boundary line. When an event happens after that date, but before you actually issue the financials, you've got to sort it into one of two buckets. Bucket 1 is an adjusting event. This is new information that gives you additional evidence about conditions that already existed at the balance sheet date. If it falls here, you must update your financials and adjust the accrual. Bucket 2 is a non-adjusting event. This relates to brand new conditions that popped up entirely after the balance sheet date. For these, you do not accrue a dime, you just disclose them if they're material.
Let's actually see how this plays out on a timeline. Let's assume December 31st is your balance sheet date, and a lawsuit was pending against your company at that exact time. Now, fast forward to February. The lawsuit settles for exactly $150,000. Finally, in March, your financial statements are officially issued. Because that February settlement gives us rock-solid evidence about a condition, the pending lawsuit, that already existed at year-end, this is an adjusting event. You've got to go back and adjust your December 31st accrual to match that $150,000 settlement.
The contrast here is pretty stark. As we just saw, a pre-existing condition demands a hard adjustment to the financials. But imagine a brand new lawsuit is filed against you in January, relating to some incident that also happened in January. Even though you haven't issued your financials yet, this is a non-adjusting event. Why? Because the condition simply did not exist on December 31st. So you absolutely do not accrue for it in the year-end financials. You only disclose it in the notes if the amount is material.
Now listen carefully to this warning because it's a super common trap. Legal confirmations obtained after year-end but before issuance are considered adjusting evidence. You can't just rely on where things stood on December 31st if your legal counsel gives you a massive update in February. You have to obtain and review legal confirmations as of the issuance date because those letters shed critical light on those year-end conditions. Don't let the ticking clock catch you off guard.
All right, let's head into Section 3, the journal entry playbook for methodical execution. Let's roll up our sleeves and get into the actual accounting mechanics. Here's your baseline execution. When a loss is probable and estimable, you accrue it by debiting your loss expense, like litigation or environmental, and crediting your accrued liability. You use your best estimate or the minimum of the range if no single amount is better. Later, when you finally settle the contingency by paying cash, you debit the accrued liability to drop it down and credit cash. But what if you over-accrued? Say you settle for less than expected, or the contingency just vanishes. In that case, you release the excess. You debit the accrued liability to clear it out and credit a gain on settlement.
Let's apply this to a highly common scenario, warranties. For warranties, it's a simple sequential process, but the timing is distinct. Step 1 happens immediately at the time of sale. You debit warranty expense and credit warranty liability based on your historical estimates of what's going to break.
Then, maybe months or even years later, when customers actually bring those products back, you're paying the actual claims. So step 2, you draw down that liability by debiting warranty liability and crediting cash or inventory or payroll depending on exactly how you fix the issue.
Let's step through a few more specific accounts. For a guarantee, the moment payment becomes probable, you debit guarantee loss expense and credit guarantee liability. For environmental liabilities, it's a bit unique. Even if a claim is completely unasserted, if it's probable that a liability has been incurred, you debit environmental remediation expense and credit environmental liability. And finally, insurance recoveries. If it's separately probable that your insurance will actually reimburse you, you debit insurance recovery receivable and credit a gain on insurance recovery.
But wait, watch out for this massive trap when it comes to insurance. Here's the golden rule. Do not net the insurance recovery receivable against the loss contingency liability on your balance sheet. I know it's tempting. You might think, well, the lawsuit costs $1 million, insurance is going to pay $800K, I'll just show a $200K liability. No way. Unless you have a strict, legally enforceable right of offset, you must always present the loss liability and the insurance recovery receivable entirely separate and gross on the balance sheet.
As we wrap up this explainer, I want to leave you with this question. If you net your insurance recoveries against your losses, what financial realities are you hiding from your stakeholders? The answer? You're hiding the true magnitude of your legal risks, and you're assuming your insurance company is going to pay out flawlessly, which, let's be honest, isn't always a guarantee. Following these gross presentation rules, rigorously checking your subsequent events, and understanding those M&A overrides protects the absolute transparency of the financial story you're telling. Keep these structures in mind, and you'll navigate contingencies with total confidence.